One of the things that is very important in macro is the dollar. And that's very simply because the dollar is the reserve currency. And it may seem counterintuitive that it's so critically important in the broad cycle, particularly for equities or even for commodities. But actually, let me explain some of the reasons why we watch it. As the reserve currency, the dollar is the provider of global liquidity. And the waxing and waning in the supply of dollars in particular, and also the price of dollars, can have a disproportionate effect on a whole cross-section of markets. And if you understand this, it can really help you to position yourself to take advantage of some big moves. So typically what we see is over an extended period of time, the dollar tends to do a big sine wave type movement. And if you can get the cycle at the right point, you can make a lot of money. So when the dollar is strengthening, as we are seeing at the moment, for example, what typically happens is that markets that are very dollar sensitive tend to underperform. So for example, emerging markets. Now, at the end of last year, we started to raise some of our concerns to Macro Insider subscribers to emerging markets. Now, we suggested at the time, not necessarily to sell them, but to start running closer stops and to monitor those markets particularly closely. Now, the reason for that is we were looking at a structural shortfall in the supply of dollars. Now, this may seem utterly bizarre, given that we've had the Fed print dollars inordinately since the global financial crisis. But the reason that this structural supply shortfall exists is very simple. The US roughly has to supply the world with a supply of dollars that increases in line with global GDP. Now, the way that it does that sustainably is running a large current account deficit. That current account deficit, as I said, roughly has to rise in line with global GDP. And the reason is very simple. If India is growing at 4% per annum, she needs 4% more dollars every single year to buy the copper and the oil that she needs to fuel that growth. And the way that we do that is to run this current account deficit. That supplies the world, pushes those dollars out into the rest of the world. Now, some bright spark needs to tell the Trump administration that they can't have the dollar as a reserve currency and also not run a current account deficit. My advice was that they would run that current account deficit and they would maintain the reserve currency. But hey, I'm not in the administration. But the point is that is the supply of long-term dollars. Now, you can make up, if there is a shortfall in that current account deficit relative to GDP, you can make up that supply by pushing out investment dollars via the capital account. And indeed, that is what US investors have done, particularly since 2010, 2011. US investors have filled a void left by a low current account deficit as the US current account deficit has shrunk relative to global GDP as we produced our own oil. US investors have filled that gap by pushing those dollars abroad. But definitionally, that money is hot money. Because in a world where you can click a mouse and bring that money home, those flows can move exceedingly quickly. And one of the things that have been concerning us as we got towards the end of last year is that we were looking for the dollar to start to strengthen. And what we were concerned is that if US investors have put their money abroad, they put that money increasingly on an unhedged basis. So when Mr. Smith in Iowa looked at his statement of his overseas investment, he wasn't really concerned whether that underlying investment had deteriorated or whether the currency had moved against it. So you could end up with a situation, let's say you'd gone and bought a Vanguard unhedged European ETF. Now the DAX could be up, that underlying investment could be up 5%, but if the euro had dropped 10%, your investment in dollar terms was down 5%. So you could sell that investment. And as that money came home, we were concerned that it would start to destabilize the supply of dollars, and that could have enormous ramifications. And first and foremost, the biggest ramification would obviously be emerging markets. And as we've seen over the last few months, emerging markets have started to deteriorate materially, and that is a trend actually we believe will probably persist, certainly for an ongoing basis. But that cycle then moves into a secondary phase. Typically what we see as the dollar strengthens, as emerging markets start to underperform, is we end up with this period of US outperformance. And it can lead to the US equity market either rising in absolute terms, as we saw from, say, 97, 98, which for emerging markets was a very, very bad period. The US equity market outperformed. As money is sucked out of the rest of the world and into the US. And that is all a function of the dollar. The strength of the dollar begets dollar strength. As that dollar strength continues, so that money is sucked out from the rest of the world. Those overseas assets underperform and the dollar and US assets outperform. So these are some of the things that most people don't actually get, right? When you look at your portfolio and you're considering, when should I be putting money in emerging markets? When should I be putting money in commodities? The dollar absolutely plays perhaps the pivotal role. To be honest, Raoul and I absolutely pride ourselves, and we believe that we've had an tremendously good run at catching that dollar cycle. And if we can help impart you with that knowledge, your ability to trade that cycle and to improve the returns that you make on your personal portfolio will be just outsized in compared to what you'll get in the rest of the street.